You're watching Captains of Industry here on CNBC Africa, and I'm speaking to Norbert Sasse, the CEO of Growthpoint. Norbert, thanks very much for joining me. I want to start with a broader context for the listed property environment, given that you have been at Growthpoint since 2003, and looking back at some of the statements that you made in the early years, it was quite a tall ask for you coming from a deal-making environment with high deal flow to move into the somewhat less sexy listed property environment. Fast track today, and you've got a very different brand when it comes to listed property. Can you weigh in?
Yes, I mean, as you say, corporate finance background, I have to confess that, when you're in that environment, it's quite a high-pressure environment, and you're doing anything from merging a hospital group one day to listing a construction group to listing an IT outfit, raising capital for an IT outfit. So it's highly pressurized, and every one of your clients expects you to be an expert on that specific industry, right? And this is, coming back from the late 90s, early 2000s, the dot-com bubble. IT speak. You got to know everything or pretend to know everything. So I was always looking for an area to specialize in, and I have to confess that property never hit the radar. I mean, property was not on the cards.
It just wasn't a glamorous industry,
not at all. In fact, in those days, the listed property sector in totality had a market cap of about 5 billion rand.
So also very small. Small,
illiquid, characterized by maybe some less savory characters, no institutional kind of ownership in there. None of the big banks were in there, none of the big life companies were in the listed space. So it created an opportunity, I think, to bring some of that institutionalization to the listed property sector, and gave me the opportunity, I think, to focus on one particular asset sector or asset class, and to live or bring the expertise, I think, that I gained in the M&A space, mergers and acquisitions, listings, capital raising, to bring all of that to the listed property sector. And
listed property now is very different to when you first entered the game.
Absolutely. I don't know what the latest market cap of the sector is. It's well over 400 billion. You've got something like 30-odd counters that are listed today. It's been the most active. Growthpoint's in the top 40? Growthpoint's in the top 40 index, pushing around about the 30-odd number. We've got another one or two hovering just outside the top 40. It's actually characterized by institutionalized kind of companies. The likes of a Growthpoint have probably become institutionalized in a way, followed probably by, Redefine sort of next up, maybe a bit more entrepreneurial, if you want, Mark's a bit more of a deal maker, maybe even more so than myself. But it's a very different space today than what you saw 10, 12 years ago.
I would be remiss if I didn't mention, you mentioned Mark Wayner. Mark Wayner, Redefine, Fountainhead.
Yep.
Big furore in the papers, argy-bargy between Redefine and Growthpoint. Your thoughts on where that all ended?
Yeah. So again, as there are only so many good retail assets out there. So the two entities that owned, if you want, or controlled them, there might be a third one. Okay, so there's Hyprop that's still out there and independently listed. There was Fountainhead, and then there was AccuCap and Sycom. And it was fair to say that Redefine, Mark put Fountainhead in play and the way in which he did it. And it was, an opportunity, I think, that was just couldn't be ignored by ourselves. It's in play. We thought that his initial offer was way too cheeky anyway. We, no doubt in my mind, offered a much better value proposition for the shareholders. But at the end of the day, he matched pretty much what we had put on the table, and maybe even a bit more. And there's a point at which, we obviously looked at the likelihood of being successful, and there's no point in now dragging it out to court. And
no regrets.
No regrets on that. No. If I look forward a bit and I see, we actually were successful on the other hand with AccuCap and Sycom, as far as I'm concerned,
it's a win-win scenario for all.
Win-win scenario, and beauty in property, like in the real world, is in the eye of the beholder, and quality of property equally is in the eye of the beholder. And I would argue that maybe the quality of what's in AccuCap Sycom is a bit better than what's in Fountainhead.
Let's talk about Growthpoint and the makeup of the company. Over the last decade, you've been quite aggressive on the acquisition front and have earned yourself a reputation as the deal maker. How does that description fit with you?
Yeah, I think it is probably a fair reflection. I think if you look at how the company has grown, it has in the main grown through acquisition of either individual properties, portfolios of properties, or true more classic M&A kind of activity. So mergers, we've done probably 3 or 4 takeovers of other listed companies over the last 10 years. Call them merger, call them takeover, whatever you want to call them. But yeah, I think it's probably a fairly apt description. It's been again a great way to grow the business, and sometimes I reflect on some of let's say my peers in the industry, not in the property space so much, but if you consider the difference between a Brian Joffe, who built Bidvest mainly through acquisition, versus a Bill Lynch, who built Imperial probably more organically. My style, or the Growthpoint way, has probably been more towards the acquisition M&A kind of thing.
The Joffe stance. Yeah. Look at the V&A waterfront transaction, of which Growthpoint owns 50%. The deal was done in 2011. Many cite that deal as being the most complex within the listed property environment. Agreed?
Yeah, probably fair to say. I think, different, first time you're dealing with international parties, you've got not only one international shareholder, you've got Dubai World on the one hand, and their philosophies and their legal team, and you've got the Livingston brothers out of the UK with London and Regional. Very different styles, very different approaches, very different ways of deal making and negotiating, different styles of negotiating. Then on our side, there's the PIC who initiated, if you want, some of the early discussions, and then asked us to come on board and maybe implement. And so balancing all of those
the different and juggling them, the different interests must have been a challenge.
It was intriguing, absolutely, yeah, very much so.
I see, just before we move off V&A Waterfront, a lot of development in the pipeline, up to 3 billion rand, still to be developed over the next 2 to 3 years. Is this becoming the star performer in your crown?
It's probably a little bit early to talk about the underlying performance. But there's no doubt that in terms of what's there, yes, it's performing exceptionally well at the moment and is the star performer in the portfolio at the moment. But the true value, I think, of the waterfront is still to be unlocked. And unfortunately, with property, and certainly that property in particular, probably is a long-term game, right? So you're going to have to be a little bit patient on the V&A waterfront for those super returns. There's some money that has to be spent.
This is about patient capital.
Exactly. When we brought that deal to the Growthpoint board, we said this is the first time we've asked. The board always looks for day one accretion, right? It has to be positive contribution to the dividends per share day one. We said waterfront, you got to be a little bit more patient. You've got bulk there, 200,000, almost 300,000 square meters of bulk. It's going to take time to develop. There's some investments you're going to have to make in infrastructure that are not necessarily going to give you your 8 or 9 or 10% yield day one, but it's going to be the catalyst for the further development of the rest of that bulk. And we're seeing that in that silo precinct at the moment. We're converting that grain silo into a museum. Now, it's fair to say that it's not coming at a phenomenal yield, but it's already been the catalyst for the new residential apartments that we're going to be developing. It's been the catalyst for a new 4,500 square meter Virgin Active gym, for a new 14,000 square meter head office building for PwC and Worksmans, for a new 4-star hotel, the Radisson Red, their first Radisson Red branded hotel in South Africa.
So extensive development in the planning.
And it's that investment, or just sorting out that silo building at sub-economic, let's say, yields, it's been the catalyst for unlocking everything else.
Your appetite for deal making and perhaps your stomach for tough environments is highlighted by the Orchards property acquisition out of Australia. Obviously now known as Growthpoint Properties, but you made this acquisition at the time of the global financial crisis. Was the value just staring you in the face, too difficult to walk away?
Absolutely. I mean, it was, that transaction was all about timing. And I think most transactions, to be fair, is all about timing. But sometimes you get the timing a little bit, not 100% right, and sometimes you hit it smack on.
And this was perfect for you.
You could not have timed this better. So in the midst of the financial crisis, you've got, there's nothing wrong with the company. If you look at the asset side of the balance sheet of that company, today, that portfolio, 5-6 years later almost, the assets that we had then are still on balance sheet and are still 100% let. They've not missed a beat. The only problem was the liability side of the balance sheet. South Africa, fortunately for us, never suffered a financial crisis. So yes, we suffered the impact of the global financial crisis in that we had recession here, interest rates went up, margins went up, the banks started pulling back their lending a little bit. But listed property companies in South Africa never feared or never had a problem with refinancing any of their debt.
So essentially it just opened up opportunities in the global environment that
Absolutely.
You could pick up at very inexpensive levels.
Absolutely. And it's so anomalous for an emerging a country or company in an emerging economy, which is characterized by high interest rates and high yields and high inflation, to be able to go and invest into a developed economy or country that is characterized by low interest rates, low yields and low inflation, to go and make that acquisition and to make it positive or get a positive spread and impact on your on the South African company is anomalous, and it was just the perfect opportunity.
Right now, are you on the outlook for any additional international properties to pick up?
I think we are. I mean, it's fair to say we know that South Africa is going through a bit of a tough time at the moment. Our growth is under pressure. And it's fair to say that a lot of listed property companies, including ourselves, are looking at, let's say, other jurisdictions, maybe a bit of geographic diversification. So, it's early days, though. I think there are attractive opportunities. What we've seen, we do have a bit of a nagging concern that it's driven mainly by the cheap debt that is on offer, as opposed to it's not necessarily supported by the property fundamentals. We always look to the property fundamentals. When I call your nuts and bolts, your bricks and mortar, your rentals, your vacancies, your escalations, your rental growth, your costs, those kind of things. And a number of deals you see at the moment are just driven by cheap debt.
So
and it's
really
a bit of a worry.
Leaving aside the fundamental
Correct.
stats
So
that you apply to
yeah.
the property industry to say
Correct.
whether that has value.
Correct. So you
down the line.
see, property yields, at the investment level are low. Property is actually reasonably expensive. There's certainly a lot more demand for these investment properties than there is supply. And then you filter through down, and you start doing your due diligence down on the bottom line. You see, leases are under pressure, rental growth under pressure. You start doing your calculation. You say, I'm actually now buying this property at above replacement cost. What's driving that? It's the flood of cheap money. And it's still an attractive opportunity. It's still very tempting to look at, but it's just, you've got to just, be a bit more careful.
Let's talk about the South African economic fundamentals. We are in a low growth environment. The first quarter GDP number coming in at 1.3% for South Africa. We've got power outages, which are occurring on a regular basis, and it doesn't look as though we've got any relief in sight on that front. And then you've got to wonder about the broader labour environment we're going in. I know a mining environment is far removed from the property environment, but right now we're going back into wage negotiations. And that comes to the heart of government-business relations, government-labour, business, civil society relations in South Africa. What are your thoughts about where we are right now?
So I'm not sure that those sort of mining, issues are that far removed actually from the property fundamentals. And a classic example would be our shopping centre in Rustenburg, where off the back of those platinum mining strikes, we saw a major impact on disposable income in the area, which filters through to our shopping centres, and we saw our turnover rentals or
it hits your
trade.
tenants, so your tenants close down.
No question, yeah. So it's all linked. It's all linked. So I think it is fair to say South Africa, with its low economic growth trajectory at the moment, the crisis around electricity, the stability of electricity supply is having a major impact on the property industry, not only on our I'm always call it, on us as the owner,
the landlords,
probably, and equally, if not more so, on our clients, the tenant. And we're seeing the impact of that in rising vacancies, rising, occupancy costs. One of the classic examples that we've seen sort of manifest itself over the last couple of years is what I would have been calling the triple whammy. So it's not just a double whammy, it's a triple whammy. The first one is that your rates and taxes have been escalating at double the rate of inflation over the last, there were some articles put out by SAPO, I think, in the last week or two. Not only are you seeing that cost pressure, but the service that you should be getting for the rates and taxes that you're paying is declining, okay, and to a certain extent disappearing. And the triple whammy is that you are now having to replicate that service at your own cost. So, if you're paying away this money, you get absolutely nothing for it. You have to incur a double expense just to remove the refuse, to read your electricity meters, your water meters, etc., etc. So,
how long before the economic fundamentals filter through into your results? I mean, you came through with a very strong first half, the upper end of expectations in terms of the growth and distribution.
Yeah. It's already there, Bron. I think it's a question of, obviously there's lag, so we report 6 monthly, etc., etc. It's fair to say that, there's no doubt, South Africa was certainly from an international investor perspective as well, you have pretty simple calculation. 8% initial yield, 8% growth in dividend as your rentals escalate, or 8% growth in rental as the leases escalate. And so yeah, it's already there. It's certainly going to come through. And I think
do you see your way clear? Taking into account future forecasts, are we going to come off this low growth environment anytime soon?
I'm not optimistic that there's visible, let's say, green shoots or visible policies, etc., etc., that are going to change things in too much of a hurry, no. So I do think it's going to be, if one expected, property is characterized by property cycles, okay, and they take 3 to 5 years to move from an overbuild.
So we're talking about the boom and bust.
Exactly.
You've been quoted as saying
boom and bust, especially right in office sector.
Well, let's stop there for a moment on the office sector, because many people watching this program are obviously tuning in from across Africa, because we're broadcasting to sub-Saharan Africa. But within the South African context and within the Gauteng context, particularly the Sandton context, from an office perspective, you're seeing that boom in building sites, head offices going up left, right, and centre.
Yep.
But you say that this is just a cycle; it will work its way through the system.
It's a cycle. So we're going to see it's you don't, and funny enough, you don't just see it in Sandton and South Africa. It's global, especially in the office sector. It's less pronounced in retail and less pronounced in industrial, but certainly office, characterized by vacancies. Typically what starts the boom cycle is vacancies decreasing, rentals firming, and funding costs being available. So the developers move in and they start developing. But any major development, Discovery up the road for example, can take 3 years from the time you start, maybe even more, till the time it's complete.
So the whole cycle could have actually gone through a boom and a bust, a boom and a bust.
Absolutely.
By the end of this.
So we're in the tail end of this sort of overdevelopment or overdeveloped cycle. Now, in the normal course, it might take 2 to 3 years to correct. So eventually the developers disappear because vacancies are rising, rentals aren't growing anymore, and finance becomes a bit less available. And I think that is the case. We should see a bit of a slowdown. But the take-up of those vacancies, and before you get to the point where the rentals are firming again, in my mind, is going to take longer. So in the past, it might have been, as I said, 3 to 5. Maybe now you're looking longer. You're looking 4 to 8 or 4 to 6 as a cycle. So the cycle will be longer before it turns around because of the low economic growth and all the other challenges we mentioned, energy in particular.
What it does bring us to is a simple demand-supply equation.
Sure.
Right now, that equation leans heavily to putting the tenant in the driving seat.
Correct.
They're negotiating hard with you at the moment,
Very much so. No, and the other thing is that the listed property sector has never been as competitive as it is today. We spoke earlier about growing from a 5 billion rand sector to a 400 400 billion rand sector. There might have been 5 competitors in 2012. Today there are 30 competitors, and I'm excluding, that's just in the listed space. The life companies are still there, you know, your Sanlams, your Mutuals, your Liberties. So it's never been, you know, more competitive than it is now. And we're all trying to hold on to our own tenants and hopefully maybe, you know, entice the competition's tenant down the road to come into our vacancy, and they're doing the same on their side.
Are you seeing very different cycles in industrial, retail and office? Obviously, notwithstanding the Ellerene's impact that certainly impacted the industrial side of your portfolio?
Mm-hmm. It's not that different, I think, Bronwyn. It's pretty, let's say, weakish, you know, across the board. You know, so certainly Ellerene's was quite a big impact. I mean, that also impacted our retail portfolio.
So both retail and industrial.
Definitely, yeah, but more pronounced in the industrial.
The warehousing.
You know, we had 3 warehouses of about 15,000 square meters each. It's 45,000 square meters goes vacant overnight. Now, in a relatively weak environment, to just pick up a tenant, you know, to fill that, you know, doesn't happen overnight. So one of them, you know, we have, the other one's imminent, and but the third one might be vacant for another 3 or 6 months, and those are big single numbers. Retail's been less pronounced, so we were able to re-let some of their space. You know, there has been some demand. There's always some repositioning in a shopping centre where one tenant wants a bit more, other one wants a bit less. So we were able to sort that out with a bit less pain. But I think it's fair to say that across all 3 sectors, you know, retail, the credit cycle is over, right? So that party of unsecured credit, et cetera, which led to the demise of Able, that party's over.
But we've still got interest rates at record lows in South Africa.
Yep.
As soon as that starts to tick up,
exactly,
there could be a lot of pain to be felt.
Agreed, because I think then, you know, we were hoping, a lot of guys were sort of hoping that the low petrol price, et cetera, was going to give a bit of extra disposable income. Hasn't quite.
Then you saw the fuel levy taking away.
Exactly, whatever upside we were hoping for. And, you know, industrial is in many ways linked to retail. So the industrial warehouses and the logistics warehouse space is feeding off what's happening in retail. So if retail's slowing, you know, it lags 6 to 9 months, and then you see the slowing in industrial. And the same with if it were to be picking up on the other side. So it's fair to say that since the impact of the global financial crisis, which led to us going into recession in, I think, 2008, 2009, we're probably seeing, you know, the environment is as tough as it was then.
Let's fast track to recent acquisitions, and here I refer to Tiber and Absec. Those have had an impact on your distribution growth, and I suppose it comes back to your Brian Joffe versus Bill Lynch model. I mean, there you've got the acquisitive growth really driving your performance. Now, just into the story is AccuCap and also the other SciComm.
Yes.
Those will only be felt, I think you bedded that all down now, 1st of May?
1st of May, yeah. So the effective date was 1 April, the implementation date was 28 April. So that's all, yeah, it's pretty brand new. I think, you know, with any of these major transactions, especially when you're buying companies, you know, you're also getting people with it. So there's
the integration challenge comes to the fore.
Sure. So there are about 160 people at AccuCap that need to be integrated into our business. They've got operations in Cape Town and Johannesburg, also some in Durban. So, you know, there's a lot of work to be done. So I think it's fair to say that the impact, or the positive impact that one was expecting from that transaction, not going to be immediate, probably more, you know, over the sort of medium term. But yeah, I mean, obviously, you know, it was a phenomenal portfolio of assets. You know, there are not that many opportunities out there to get a 12 billion rand odd retail portfolio of high quality retail assets, complemented by a really high quality office portfolio as well.
What do you think the next couple of years hold for Growthpoint, and perhaps more for yourself personally as the leader of this organization?
So I think, you know, it's fair to say, you know, and again, if you look at these acquisitions and the financial impact, that we have got to a size where it becomes quite difficult for the M&A opportunities to have a meaningful impact. You know, after these most recent acquisitions, we're probably going to be close on 100 billion rands worth of property assets. That includes our Australian entity at about 20 billion. Now, to be buying or developing, assets that are going to materially move the dial, it's only, you got to understand that now you have to look at bigger opportunities.
It becomes very difficult the bigger that you get.
Very difficult to move the dial, absolutely. So, I think we've been successful over the years in incrementally improving the quality of our portfolio whilst pursuing this acquisitive growth platform. So it's fair to say that maybe there are some assets that we might want to, get rid of, that have sort of a bit of a tail might have developed, and we, looking at some strategies that I might get rid of that more efficiently.
So some tidying up of the portfolio.
Tidying up of the portfolio, fine-tuning them operationally as well. Our business is scalable, but only to a point. It's not like, the real third-party asset managers like a Coronation and these guys, which are they appear to be almost infinitely scalable. We manage, the properties. We've got letting and leasing, facilities management, etc. So one person can only manage 2 or 3 or 4 buildings. They can't manage 50 buildings. And the minute you start putting too many buildings into that equation, you have to start fixing your own infrastructure. You've got to put more people, look at your structure. So I think we're going to be spending some time on that certainly for the next 12 to 24 months, optimizing our structures so that we can optimize the way we manage the portfolios. We're very sectorally focused, obviously, with retail, office and industrial.
So now it's about bedding down operations, focusing on internal workings.
Correct. And how can we leverage the returns on the capital that we have invested? It's actually, it's property, so it's characterized by lower volatility, lower returns typically, and more certainty if you want long-term leases, etc. So are there ways in which we can leverage some of the returns that we earn from the real estate that we've got? Arguably, we've got some of the best real estate in the country. How can we leverage those assets and the positions that we've got there to drive returns to shareholders?
Norbert, it's always a pleasure. Thank you very much for your time. I've been chatting to Norbert Sasse, the CEO of Growthpoint, and you've been watching Captains of Industry here on CNBC Africa.